Hey guys, I'm excited to share this video with you. It's Peter Mcfarland, my personal tax attorney, and he's got some really cool strategies on how you can save more money in taxes. And one of the cool things is recently the laws have changed. Uh, I'm excited to share this with you. This is Peter Mcfarland. He's my personal tax attorney, and he finds really creative ways of not paying taxes. Okay, and so you're going to learn a lot of ways, especially after this new tax change in the law. That there's a lot of things that you don't know already, and he does, and he's found out ways to help you pay even less in taxes. So, without further ado, here's Peter Mcfarland.
I kind of helped right at the very beginning to grow into something so successful is really rewarding for me, right? And so I don't know, just really wanted to give a quick shout out to them. I do have to let you know, at some point we're going to lose my laptop today. I came with hardly any charge, no idea that was going to happen. So I actually like that because maybe we can turn this into more of a discussion. What's life without a little bit of variation, right? If I stick to the slides, it can be really boring. And this is already probably going to be a little boring, I fully recognize. True story, I was actually driving over here and I got a phone call, over the car or whatever, and my brand new wife, she was calling, and she said, "Peter, I'm bored." And she's at work today. She said, "Peter, I'm bored." And I tried to give her some suggestions of things to do, and I said, "Well, heck, you could come out and see me talk." And she said, "I'm not that bored." So to see a full room and to see you guys here and excited to learn about something about tax actually makes me feel great. And we have another tax attorney in the room too, which is awesome. And as I'm going, if you have anything to add or insights or anything, by all means, I'm willing to share the floor. So today we're going to talk about real estate professional status with the IRS and how that works under the tax code. Let me ask really quick, just by show of hands, do we have any people in this room who are taking that status, that real estate investor status right now on their tax returns? Okay, sure. So just a smattering here and there. Really, it's something that everybody should consider if you actually qualify to do this, because it can be a really powerful election to take with the IRS, and it can be a really powerful money saver. And so it's something that everybody should heavily think about, or at least sit down with your CPA tax preparer to discuss and see if it might be worthwhile. Just a quick word about me and who we are. I'm an attorney. I've been doing this for many years now. Went to the University of Denver, passed the bar exam on the first try, thank God. Then went back to University of Denver and studied nothing but the tax code. I have an advanced degree, a Master of Laws in Taxation, and basically my family thought I was nuts, but after I passed the bar exam, I said, you know what, I want more school. And I went back and just focused on the tax code. It is as dry as you think it might be, but actually it was about the most fun I've had in school the whole time I went. CPAs are a very interesting bunch, and the class that I was in, my graduating class, was about half attorneys, half CPAs. And some of the friends that I made there and some of the perspectives that I picked up was a lot different from law school, and I really actually would not trade that year for the world. It was awesome. But from that, I was able to land my first job in a law firm. I worked in the University of Denver Low-Income Taxpayer Clinic for a while, represented underprivileged taxpayers when they were kind of getting beat up by the IRS. And from that skill set, then I was able to start servicing clients full-time who were also getting beat up by the IRS. Anymore, I'm limiting my practice in that area because after the number of years I've done this, it can be a little bit of brain damage dealing with a big bad agency, right? And so now I'm beginning to get more into tax planning and structuring and asset protection, estate planning, right? Things that people are actually excited to hear about me from, right? When I called them before, they were saying, well, what's the IRS doing, right? It was always going to be bad news in a way. But now when people see me, they're actually excited. So I think that's a fabulous development in my career. I put up the website here, longlg.com. If you haven't had an opportunity to work with us, we're a small firm, just two attorneys, myself and Stephanie Long. We have a CPA, we have a bookkeeper, we have a paralegal, and some office staff as well. So, and we're actually looking to expand our offerings now into business consulting, cash flow analysis, some other things too. So this year we're actually going to, this next 12 months, not calendar year, we're going to look to expand aggressively, offer a lot of new services. So check out our website as these things come along, because we're very excited. We're going to bring a lot more value to our clients here in the next 12 months. I've been featured several times in the Colorado Real Estate Journal, not recently because I've been planning wedding and it's just been too much brain damage to try to do anything else. But I'm looking to get back in there in the next 12 months as well. So if you do read the Colorado Real Estate Journal, look out for me in there. As well, I'm going to start upcoming education. I'm going to partner with a few people around town. I have a few coming up with Blue Spruce as well. And then I'm looking to launch a series of education myself. It will happen at the conference room in my building. So again, check out our website. There will be more details coming about that. So if you've ever seen me speak, I give a little bit of roadmap about where we're going to go, what we're going to talk about. Now this will kick out at some point, so the roadmap may be somewhat meaningless a little bit later, but for now it's useful. I don't often get to get up on a soapbox and kind of talk about something, so I'm going to give a quick opening perspective, which kind of leads us into what we're talking about today, which is taking this real estate investor, real estate professional status under the tax code and with the IRS. So when a bunch of doctors and lawyers get together, what could go wrong, right? Back before we had this real estate professional status, what we had were what Congress termed abusive tax schemes, right? And what happened was a lot of these doctors and lawyers got together and they started investing into real estate and took massive paper losses through depreciation and things like that, and offset the active income from their law practices and their medical practices. When they did that, they were generating these large paper losses, but they were cash flowing like crazy and not paying tax on the cash flow, right? And so Congress identified this and said, this is a massive tax loophole. We need to close this, right? And so they did. They ended up creating this new kind of category of income called passive income, right? And so rental real estate in particular is what I'm talking about here. Rental real estate, the way that the tax code is drafted, is a per se passive activity. That means that any income coming off of there, there's going to be a presumption that it's going to be passive income. When income is considered passive income, you're limited in your options for how you can harvest losses coming from passive sources, right? So I call it passive income, but we could also be talking about passive loss. So if I start to not make sense, please let me know. I'm having a day where I feel like I need to get back on my meds. I'm not on meds, but just having a day where it's just, I woke up today and it's like, oh, of course this is the day that I'm going to be doing some public speaking. And I think this is convoluted. And so if I'm getting turned around or you're kind of beginning to get lost, please just stop me. Let me know, right? If you're feeling lost, you're not the only one in the room feeling lost, right? So just let me know. At any rate, so passive income can generate these passive losses, and we're limited in how we can harvest those losses, right? And what income we can actually offset. And there goes my laptop. So we're limited in what we can actually, or how we can harvest those passive losses. So what I'm going to do is tell you today some strategies to actually speed up how you can take those losses, right? Thanks, Adam. That way I don't have that blinding blue light in my eyes, right? Okay. So the easiest way to think about how passive income and how passive losses work is to almost think about it in terms of two different buckets, okay? When you have a W-2 job, for instance, me as an attorney, I get my paycheck from the law firm, it's going to go into one bucket, and that bucket is going to be considered active income, right? Or the code calls it non-passive income, but I'll just call it active income because it's easier. So you have active income. You have rents being paid off of rentals. Rentals are per se passive, and so it just goes into a separate bucket, right? You have passive income. So you have two separate types of income. Let's say that you actually have loss coming off of rental real estate, right? And that may actually be generated by depreciation or something like that. It may not actually be a loss, right? It may just be, when you look at the financials and for tax reporting purposes, it may be a loss even though it cash flows. In that case, that loss is actually going to go over into that passive bucket, right? And so we have these two separate buckets. We cannot, let's say that we have $30,000 of passive loss and $20,000 of active income. we cannot offset the $20,000 of active income with the $30,000 of passive loss because they're in those separate buckets, right? And so what we have to do is carry forward that passive loss year after year after year. If at some point we have enough passive income, we can harvest that loss and begin to offset in the future year that income using that passive loss, right? Otherwise, if we show loss after loss after loss after loss because depreciation is, pulling your income down and it's actually showing loss for tax reporting purposes, the only time we can harvest that loss is when we sell the property. So we might be stuck with that loss and we can't harvest it for maybe 15 years, 20 years, right? And so what real estate professional status allows you to do is speed up when you can recognize those losses. What we're going to do is we're going to offset, in my example, that $20,000 of active income immediately this year, right? We'll use the passive loss, and we find a way to bridge the gap between those two buckets, right? Does that make sense, everybody? Okay, all right. So it sounds great, right? How do we do it? I like to think about it in terms of 3 flaming hoops, okay? You have to jump through 3 flaming hoops to take this status with the IRS. Why is it a flaming hoop and not a primrose path? Anybody?
It's the IRS.
It's the IRS. That's a very good answer. Yeah, audits. Yeah, absolutely. Tax. Does anybody know the difference between tax avoidance and tax evasion? 15 to 20 years. Right. And what we're trying to do is we're trying to do tax avoidance, right? We want to pay no more than what we're supposed to pay under the code. If we begin to get into tax evasion, then we have a problem, and then we're looking like Al Capone. But what we're trying to do here is we're trying to structure under the tax code to legitimately take advantage of tax laws and not pay a single penny more. So how do we do it? We jump through 3 hoops. The first hoop you have to jump through to be a real estate professional is you have to spend more than half your time in trades or businesses in real estate, okay? I cannot qualify under that test because I spend more time as an attorney than I do in anything else, right? And so I will never be a real estate professional as long as I am an attorney. If you're working a W-2 job, same story, right? Unless it's very part-time, something like that, you have to spend more than half your time in real property trades or businesses, okay? Now, it can be different ones. You can fix and flip, you can rent, you can invest other ways in real estate, tax liens, something like that. But it has to be in those real property trades or businesses more than half your time. So that's flaming hoop number 1. Flaming hoop number 2, you have to spend more than 750 hours in the year in real property trades or businesses, okay? So 750 hours is your kind of tipping point. You'll keep track of your hours, and we'll talk more about record keeping here in a second, but you have to actually spend 750 or more hours in real property trades or businesses. The last is that every single real property trade or business that you're counting towards those 750 hours, you have to what's called materially participate in those activities. What is material participation? There's 10 or so different tests under in the Code of Federal Regulations that allow you to meet this material participation. I'm going to see if I can remember these off the top of my head. I won't get all 10, but all 10 are not going to actually apply in this case. One, for instance, is kind of a catch-all. I will say, take this one with a grain of salt because I have used it in litigation before and the IRS never goes for it. I've never seen a case where they say, oh yeah, you're right, okay, I'm going to let this one go. It's under all the facts and circumstances, under all the facts and circumstances, you spend, sorry, this is where my memory is getting spotty. Under all the facts and circumstances, you spend a significant amount of time in the activity. It's something along those lines. I'm paraphrasing a little bit. You can see that's so general, that's why the IRS doesn't go for it, right? They say that's super gray, we're going to go litigate it, right? We'll see what the judge says. And nobody wants to take on the risk that the judge is going to disagree. So that's not a very good one to rely on. Another one that you can rely on for material participation is that you spend more time in the activity than anybody else in the activity, right? And so if you actually count all of the hours of everybody involved with the activity, if you're putting in the most time, you materially participate. Okay? Another one is there's a tipping point with the number of hours. It's more than 750. I want to say it's 950. That, again, is relying on my very shoddy memory. What I'd recommend, because I don't have the slide right in front of me, if you're interested in more of this material participation and how you meet that, shoot me an email and I will send you all of my slides, okay? And I have all of those material participation tests on there. So my email address, just so everybody knows, I'll just give it to you right now. It's P. Mcfarland, just my first initial last name, PMCFARLAND, and that's at longlg.com, like longlawgroup.com, okay? And of course, feel free to come up afterwards and we can talk more about it. So at any rate, let's go back to the 3 hoops. You have to spend more than half your time in real property trades or businesses. You have to spend more than 750 hours in real property trades or businesses. And then every single activity that you're trying to count towards this 750-hour requirement, you have to materially participate in, okay? When you jump through all 3 of those hoops, you have satisfied the requirement to be a real estate professional. Are you automatically a real estate professional? Can you just take the election with the IRS? The answer is no. You actually do have to make a formal election. And so you have to partner with the individual preparing your tax return, or if you prepare your own tax return, you actually need to make an election on the back of the return. There's a special sheet, well, it's not a special sheet, it's just a sheet on the back of the return, just staple it on. It's a statement, and the statement will just say that, essentially, pursuant to, the code section, I elect to be a real estate professional. At that point, you want to hold on to that like gold. The reason is because we've actually litigated these cases before. They might be auditing years 15 and 16, but they made the election back in 2008. The IRS wants to see that 2008 return with that election on it, right? And so record keeping says, hey, hold on to the last 3 years of returns. In this case, if you make a special election like that, you need to hold on to that return really indefinitely until you stop taking the position, right? So make sure that you hold on to that like gold. So any questions so far? Have I lost anybody? Yeah, Tina.
Well, you've elected, you're not taking that yearly. They're saying you make the election once and then it's until you let the IRS know you're not taking it.
Correct, yeah. So for everybody, make the election and hold on to that. It wouldn't hurt, Tina, to make the election year after year after year just to make sure that it's in place, right, and that the IRS has a record of it. But is it strictly required year after year to have that election on the back? I don't believe so. Yeah, good question. Yeah.
You might be addressing this later,
Mm-hmm.
and if you are, then no worries.
Yeah.
What if if you're filing as husband and wife and one person is taking the election, will all the income qualify?
Yeah, that's a really great question. I'm glad you brought it up, actually. So the question was, if you're husband and wife, right, and only one of you is going for this real estate professional status, will the income of the other person count, and can you, is it all kind of one picture, I guess is kind of a way to put that, right? And the answer is yes, and that's the most beneficial way to use this election, in my opinion, right? If you are a real estate professional and you manage to show losses in their passive losses, otherwise passive losses if you didn't have this real estate professional status in place, you can actually use those losses to offset active income of your spouse, right? So if your spouse is working a W-2, you can offset some of their active income using your passive loss. So it's absolutely the way to look at doing this. I think it's a really smart move. Does that answer the question? Yeah. So any other questions right now?
I've got one.
Yeah, Michael.
This real property business, builders that are doing some fix and flips, but working also for somebody else, do they have to keep 50% of their income coming from their fix and flip or buy fix and holds in order to qualify for that 50%?
Well, I'm going to try to answer. If I don't quite answer, let me know. The income, in a way, is not relevant to whether you're going to be a real estate professional. It's the hours, right? And so your time in construction that's going to count towards the 750 hours. It's going to count towards maybe material participation if you can group things, and we'll talk more about grouping. But I think the question is, okay, the time spent in construction, does that help you qualify as a real estate professional? If the answer there is yes, then you can look at the income and say, okay, out of all of the income I made in real property trades and businesses, what out of that income is passive and what out of that income is active, right? And then, it's kind of bizarre because depending on how your 1040 comes together, you may have active income, say, on Schedule C or coming through Schedule E because of your company, S corporation, partnership, whatever it may be. And so some of that income may be able to be offset by the passive income coming in. And the passive income, just because now I'm getting really technical with forms and everything, it comes through on a different form. I believe it's an 8582. But where that winds up showing up in another spot kind of depends on the source of the income and everything else. So it gets really technical. But did that kind of answer your question? I think the first question is, okay, do you qualify as that real estate professional? And then if so, what's the story with the income and how much of the active income can we offset with the passive income? Yeah. Does that help? Yeah. Okay, great. Is anybody completely lost yet? It's okay if you are. All right. So I think we've talked and pretty well covered what it looks like to take this election and what it means to take this election. Let's talk about best practices if you do take the election. As I mentioned, I have litigated these cases in tax court currently, but I'm sure I'll get another one. At any rate, let's talk about record keeping. Because everything is so driven by the hours and how many hours you're spending in these real property trades and businesses, you do need to keep good records of your time. And what I think is best is just straight up a handwritten notebook with start-stop times, and then as well as a description of the who, what, when, where, and why. Now, why I say a notebook, handwritten, is unfortunately, we have apps, we have all of this great technology, and I wish we could use it. The tax code, on the other hand, was written in 1986. We have some new changes this past year, but by and large, 1986. The Code of Federal Regulations that interprets that tax code is nearly as old, occasionally updated. But really, the Code of Federal Regulations and what it requires for record keeping envisions 1986, when we actually hand wrote everything, right? The IRS, they like a record that they can look at and that they can verify wasn't changed, wasn't altered, say, 2 weeks ago, right? And so if we're keeping an Excel spreadsheet, they may be able to look at time logs and that kind of stuff, but then we're getting really CSI and, they're looking at your laptop and that kind of stuff. They want to look at it and make sure that you didn't create this log 2 weeks ago because you knew they were going to meet with you, right? I had a very aggressive IRS attorney working on the other side of one of these cases with me. My clients had produced, they actually kept a handwritten log. They had it. It was maybe 2014, I think was the year we were looking at. So at the time, I was probably working on it in 2016 or 17. So it was 2-3 years old, right? At any rate, the attorney looked at it, and what they had was, a date entry, a name of where they went, and then it wasn't start-stop. It wasn't 8 o'clock to 9:30 or something like that. It was just 4 hours, right? And consistently, it was these very large estimates of time in hourly blocks. Never was it 4.5 hours, 4 hours, 15 minutes. It was just always 4 hours, 8 hours, 6 hours. And what was really weird about it was those estimates of time looked like they had maybe been added after the fact. I asked my clients, I needed to know what our hazards were. I said, look, did you guys add this after the fact? They, of course, said up and down, no, we didn't. It's all, contemporaneous. But the IRS attorney looked at it, and he said, I'm just not buying it. And he was trying to get us to settle. We weren't settling. We were convinced we wanted to go to court. And he actually threatened to make a referral to the crime lab, Whether the IRS even has one is debatable, but referral to the crime lab, they were going to look at the ink under the microscope, test it, and if it had been added later, he was going to make a fraud referral, which then is a criminal offense, right? So that brought it to a whole new level. I had to take that back to my clients and say, are we worried about this? Do we think there's exposure? But all the same, they can be very aggressive, but the main thing is, if you have electronic records, there's no way for the IRS to do that kind of testing, and they want to see that kind of testing and make sure that these are contemporaneous records created 3 years ago, right? Best practices, keep that handwritten log. You want the who, what, when, where, why, the hours, the start, stop times, and a description of what property you're actually associating the time with, right? We want to be able to look at it and say, well, why did that particular rental take 3 times as much time as this other rental? And that may actually be a really good fact to work in your favor, because you say, well, it needed a new deck. It needed, all of this rehab work, and I put in all of that time, and that's helping me make this 750-hour requirement, right? Facts are always in how you spin them. The other thing I would say, best practices, is when you're trying to meet that 750-hour requirement, you want to be well over that 750-hour requirement, because without a doubt, the IRS will look at your time log and they will disallow hours, right? They'll say, we're not going to allow about 20% of those hours, right? So you want to be closer to maybe 1,000 hours, right? So when the IRS does that, you're still well over 750. We can concede those hours and still meet the test, right? The most difficult cases that I have done where I'm representing clients on this is the ones that fall right on the fence, right? They're at 780 hours, something like that, and I'm looking at it and I'm saying, boy, we're going to lose quite a few of these hours, and that's always the really tough ones. The other thing, just a word of caution, I'm not trying to bring the energy down in the room, but the word of caution on this is that because the election is so powerful and the potential to offset so much of this active income is there, the way that the return is prepared, you may actually wind up with a much different tax result than if you had not taken the election, right? And the IRS has something called a substantial understatement of tax penalty. And if you wind up being so far off in the preparation of your tax return that the way that the return is actually prepared and filed is nowhere near accurate to what the actual picture should have been, the IRS slaps you with this penalty. It's a 20% penalty. It's hefty. And so when the IRS does disallow these hours, and then we're looking at, okay, is the election even fair to take at this point? Unfortunately, sometimes, I would say most of the time, that 20% penalty is going to apply.
If you can demonstrate that this is your full-time thing, you don't have another job, does the issue of the hours become less of an issue to prove, or not? Because if you're full-time, this is what you do. I mean, that's all you're doing. That's everything you're doing. So, can they really push back against that?
No, that's a fair question. I mean, if you're not working a W-2 and all of your time really is spent in real estate, does that help meet the hour requirement? The answer there is no, and the reason is because of the type of hours that are going to actually apply to the 750-hour requirement. I'm glad you brought this up because it brings me in a new direction. The IRS wants to see you, because it's this, you have to materially participate, you have to meet that test. They want to see active hours involved with these properties, right? They want to see you actually out there vetting potential tenants, right? Obtaining advertising, going and cleaning the carpets, or hiring somebody to go clean the carpets even. If you're spending time, this is going back to one of the cases that I did represent clients on with this, they were looking for new rentals, okay? They lived in, where was it? They lived in Mississippi, and of course they had been hit by several hurricanes, or in the past year. And so now the Congress has created this whole GO zone down there, and a lot of people are looking in the GO zone because they can get, well, at least they were. I don't know if they still are, but they were looking in the GO zone because they can get properties for cheap, and potentially the returns there were very good, right? And so for a while there, we saw a lot of that. So they went into the GO zone, they kept track of their time, but again, doing the very large lump sum of hours, they would go drive from Mississippi over into the go zone and take maybe 8 hours, 10 hours in their log, right? And just say, research new rental properties, right? Well, the IRS looked at that and said, that's not active enough. You're not at a property. You're not putting time and energy into a property. This looks more like an investor in the stock market managing their portfolio, right? It's kind of the same type of activity as that. You're researching what stock you may buy next or something like that, right? And in this case, rather than stock, it's what rental property you might buy next. But those type of, I guess, more overarching investor hours, right? Those are not going to count towards that 750-hour requirement. And so when I say that the IRS is going to look at your log and disallow about 20% of your hours or something like that, it's probably going to be under some theory like that, where they say, well, I'm seeing a lot of going to a post office box. I'm seeing a lot of going out and researching where my next property is going to be, so we're just disallowing those hours. Right?
So drive time to an active rental that you have could count.
If you're checking up on the property, yeah.
So what about stuff like education? If you're attending conferences, attending classes?
It's difficult. Yeah, it's difficult. So the question is, what about education and time spent to learn about more about real estate investing? I have seen hours allowed for that. I've seen hours disallowed for it. And I think it comes down in that case to the level of detail and granularity you're giving the IRS. If you're giving them, I went to this location to see this particular person talk, here's a flyer that discusses what they talked about, the IRS is more inclined to allow that. If, on the other hand, you're back in the scenario where you're saying, 3 lump hours spent on education, the IRS says, we don't even know what this is for, right? And so they're more inclined to disallow that. I think in that case, and this goes to audits generally, it also comes down to who your auditor is, right? There are, I hate to generalize, but there are older auditors who are more inclined to look at the big issues and kind of let some of the smaller stuff go. There are younger people who have something to prove and they dig in on every single issue and really hold you to the coals on everything, right? And so in a way, it's luck of the draw as well. And in the case of that one I was talking about with the fraud referral, you could have a really aggressive agent, right? And there's not much you can do about that. You kind of have to go through the paces, and there are levels of appeal you can go through and hopefully get fresh eyes on it. And somebody may say, that's a little unreasonable, we'll back off of that. But it's going to depend somewhat on that as well. So does that help? Yeah.
I'm not sure I heard. I have a number of questions actually, so
great,
give as much free service.
Yeah, rapid fire. Yeah.
The travel time. I didn't quite hear your answer to that.
Well,
is that allowable?
It depends, I think, on what the travel time is for. If the travel time leads into active hours at the rental property, right, then I think that's going to be allowed. If, on the other hand, it's in the case of the clients I was talking about with the Go Zone, if you're traveling and it's more of that overarching management of your portfolio, kind of more generalized, or looking for the next rental property or something like that, the IRS may disallow that. Okay.
So I have multiple spreadsheets. It sounds already like that's a really bad idea.
Well,
so and I track what property I'm going to, and the spreadsheets are nice because I can automatically calculate just by putting in a yes or no how much mileage to what property and what, because I already have the mileage in there in a calculation.
Oh, sure, yeah. Doing those formulas
the formulas are really super easy. I mean, do I have to print these out, or is that a bad idea? Do I have to go through this from January 1 and write this out by hand, or?
I'm not going to say that your spreadsheets are worthless, because I don't think that they are. I would take them to the IRS with a completely straight face, and I would absolutely defend them, produce them, rely on them, tell the IRS that this meets the requirements of the code, because I well and truly think that it does. I think if you're going to proceed using only spreadsheets, no contemporaneous written record, handwritten, I think you just have to view that as some hazards of litigation in a way, right? Let's say that we did get audited. You got audited, you hired me, I'm representing you, we're going forward. We go through the audit, the auditor looks at all of the records and looks at your spreadsheets and says, okay, I'm going to disallow real estate professional status. The first reason is, these are not contemporaneous written records, so I kind of have a problem with the documentation. And what they would say is that it's a problem of credibility with the documentation because they could have been modified 2 weeks ago, right? It's the same reason, this goes back to a larger issue. If you're ever audited and this is not a result of real estate professional, just in general, the IRS will ask for QuickBooks or something like that. They want to see the overarching kind of, P&Ls and general ledgers and that kind of stuff because it's very easy for them at a high level to see everything. But they don't just rely on QuickBooks, right? And that's because QuickBooks can be changed at any point. They'll want to see actually all of the bank statements. They'll want to see all of the receipts, right? Everything needs to be produced, and it's because they're going to verify what's in QuickBooks. Or if it's not QuickBooks, your Excel spreadsheet or whatever you're using, but they're going to verify that against the actual documentation because they can see those receipts, right? So in your case, the spreadsheets in a way are almost like QuickBooks. It's useful. But the hazard there, if it were to move forward, the auditor disallows it. First reason is credibility of the documentation. The second reason is probably because they'll disallow 20% of the hours, and they'll come up with a backup kind of position, right? So then we move forward, we go to appeals. The appeals officer might agree with us and say, I'm not really going to be a stickler about that. We'll accept these spreadsheets. But maybe the appeals officer looks at it and says, I agree. And then we have to move forward to tax court. And then we have a bigger problem because tax court, the requirements there for documentation are, I would say, more stringent. So you occasionally can get from the IRS what's called a hazards of litigation settlement, right? If we go so far as tax court, they may look at it and they may say, we think that the IRS would win if we went to trial, but we think there's a 20% chance you might win. So we'll concede 20%, and basically you get 20% of the position you took, and they'll take away 80% of the benefit of it, right? So if you move forward just using the spreadsheets, you might look at it and say, well, to make my life easier, I'm weighing that and saying, hazards of litigation, maybe I lose this, but it makes my life that much easier in the end. Does that make sense?
Yeah, absolutely. So if I'm also creating a spreadsheet for not only the property management and that I do and all the leasing and whatnot of my own properties, but also my real estate work, my realty work, my working with clients and investors and whatnot, that doesn't count towards the 750 or 900, or
it would count. No, yeah, the time spent as a broker would count towards being a real estate professional because you're putting time into real property trades or businesses, right? So if you think about it, you can do everything under the sun with real estate. You could buy tax liens, you could have rentals, you could do rehabs, you could be an agent, you could all this stuff. And even though each of them are distinct because they're different activities, every single one is a real property trade or business. And if you look at how the court defines, and it comes from court cases, it doesn't come out of the code or the regulations, how the court defines real property trades or businesses, it's very expansive. They're actually going to try to pull as many different activities under that umbrella as they can. They're not limiting that to just rentals or just, they use a really broad definition. So I think your time as an agent certainly will count towards that 750 hours and the requirements to be a real estate professional, but then the income that you're generating off of that isn't going to be the passive income, it's going to be the active income. And so the passive that you generate will offset that active, but it's not, your agent income isn't going to offset other active income you might have. Does that make sense?
Yeah, absolutely. Yeah. So one last question.
Yeah, sure. I said rapid fire.
Yeah. Fire away. So I'm happy to hear that because I didn't raise my hand earlier, but I have been for a couple of years now filing my taxes as a real estate professional.
Great. So,
but I have these two buckets as a broker as well as a property owner and manager, right? But so, I know this may just be an opinion, but with your experience in litigation, at what point does the IRS say, "Hey, we want to audit this guy"? At what? Seriously, right? Because if Joe Schmo's only got one property and he's saying, he's writing it off, but he's only making $5,000 a year, and saying he has 10 grand in losses, that's not worth their time. So, in your clients maybe are millions of dollars of profit and losses, or
well, so the question really goes back to what is the risk of audit, and in this case, I would say what is the risk of audit really generally. The IRS, they do not have the bandwidth to audit every single return, and they don't even really have the bandwidth. they don't really have the bandwidth even to audit every single issue that they've identified as potentially abusive, right? That's kind of their wording, not mine, because again, I'm into tax avoidance. I don't view it as abusive. But at any rate, in my experience, just speaking generally, those who are selected for audit, they come from a few different camps. Number one, there are those that just well and purely won the lottery, right? It's the world's most unlucky lottery, but occasionally, out of the blue, you will have just an audit because the IRS randomly selected you, right? That does happen. The next one is a really aggressive stance on the tax return, and this is maybe what you're envisioning my clients may be, although my clients are maybe not actually in that category. But yeah, if you're showing, say, $1 million loss, the IRS might be interested in that, right? Because they say, hold on a second, where did this come from? Is this actually valid? The third camp might be those who have filed an amended return, and maybe they're all of a sudden showing that $1 million loss, or maybe they're moving it to a different year, or maybe an amended return occasionally can trigger an audit as well. That's not to say you shouldn't amend your returns because you want to be in compliance. If there's a reason to amend it, you should. But if all of a sudden there's this really kind of goofy adjustment, and also it's large enough that the IRS is kind of saying, well, why did you miss that the first time you filed, right? That might be a reason to audit. So in the case of real estate professional status, where the audits may happen, I think would be offsetting a large amount of active income with a large amount of passive loss. That's probably the most common. Although, once again, the IRS, as I was saying, they don't have the bandwidth to audit every single issue, but there are hot button issues that they are auditing because typically they're ones that people are confused about, or often they're ones that they win or are able to make adjustments about. Schedule C, if you're filing, say, as a sole proprietor and you're showing loss after loss after loss, year after year after year, that's typically an audit flag. Real estate professional, I suppose, is maybe more of a potential risky position. But honestly, like I said, I'm actually not handling any of these cases right now, and so I may have actually seen that drop off a little bit. Because before I had one every single year, at least one, if not two. So the fact I don't have one now, maybe that's a reflection. Although maybe we're just lucky this year. So I don't know. Maybe that gives a little bit of perspective. Yeah.
Thank you.
Sure. Yeah. What's up?
Relative to the logistics, like I know myself enough to know I have a ledger, like a written ledger. I'm not going to do it. Mm-hmm. So one of the ways to work around that is the idea of creating just an email address is easy to create. If you have a running spreadsheet, you're just routinely sending yourself a spreadsheet. All you have to do is give IRS access to your email, which just has your spreadsheets in it. So therefore, their date stamp, you can't really modify it. Is that feasible?
Yeah. So the question is, okay, if you say that you're going to do a written log, you're just not going to do it. And that's realistic, and I appreciate the honesty. I mean, really, because I wouldn't do it either, if I'm honest. So only because. I just too busy. No way.
Because we have electronics.
Yes, right, exactly. Because it's 2018. Absolutely. But all the same, if you wound up emailing yourself, let's take it one step further. I mean, if you emailed yourself spreadsheets, you're right, they would be timestamped. You could produce that. Let's take it one step further, though. If you didn't even produce the spreadsheets, you just emailed yourself with, start time, stop time, what you did, where you went, whatever. I mentioned the different levels of review. I think if we started and we went to the auditor probably wouldn't accept it. If we went to appeals, which is the next step, right? Appeals, they might give some weight to it, and it's a litigation settlement or something. I can't guarantee that. My sense is probably, and again, it'd come down to the appeals officer you have, but my sense is probably the appeals officer also wouldn't give you anything. So then you're going to go to tax court, and then the IRS attorney may give you some kind of settlement offer, but ultimately that would go to, I think, the judge. What's tricky about that is that then, I don't know what the IRS would do with it, because the IRS may not want precedent out there that says that somebody could use email as a record-keeping mechanism, right? And so to some extent, we could make an argument that's like, well, IRS, you may not want that out there, or settle with us, right? How far that goes, I really don't know. So you could do it, maybe it works, but I think you're still, once again, in the very gray, risky area comparatively to keeping a handwritten log. So long way to not really give you a great answer, but all right, appreciate it.
So would it be then advisable to have both the spreadsheet and the handwritten log in the audit, so you can show them both?
Absolutely, yeah.
And then should the handwritten
Maybe
log...
your priest can sign off on it too? Would that help?
So that should be advised that way. Because I like the spreadsheet too, to sort it and all this stuff, and,
Yeah.
bring them both to the audit.
I think so. I mean, if you want to be on the safest ground and you're the most risk adverse, having the handwritten log is absolutely what I recommend. Now, if you want to create a spreadsheet on top of that to run formulas and everything, great, And really, realistically, it's going to save you time, effort, and energy, and potentially cost if you ever are audited. Because probably, let's say that I'm going to represent you. I look at your handwritten log. The first thing I'm probably going to want to do is actually put that into Excel so we can run formulas and things, so I can make my arguments and say actual, large 8.5 by 11 sheets, whatever works. As long as it has the information on it, that's really the key. Aside from that, I'll give you a perspective here, which is the very first case I ever handled on this issue. My client sent me 2 large banker boxes of records to corroborate 1 year, right? Being a new guy and also somewhat green and not necessarily, what I did was I went down to the IRS offices and I had the 2 boxes with me and I just kind of put them on the table and I said, where do you want to start? And the IRS didn't necessarily want to do that, and so they were maybe a little more inclined to actually settle, right? Another case that I handled maybe 2 years later, I did the intake. I said, well, this comes down to documentation, 750 hours. They're probably going to disallow however many of your hours, 20% or whatever it may be. What's your documentation like, right? And they said, oh no, it's all documented, it's all great, And what I do, I get basically just 2 spiral-bound notebooks, and that was it, right? That one, the IRS really mopped the floor with us because there wasn't a whole lot of detail in there, and it didn't have a lot of kind of corroborating information. So in the case of the 2 bankers boxes, I could look at the time entry, and then I could pull some information about what they did at the property. And if they went and looked, say, at a new property, even though that's investor hours and the IRS might disallow that, they had a printout of the address of where they went and the property they looked at. They had information about what the person was asking for, maybe what they would offer, all of that. And all of that looked really good. The IRS looked at that and said, this looks really good, right? On the other hand, the 2 spiral-bound notebooks, and these were the same clients who had the very large lump time estimates, right? And it wasn't very granular. It was just 4 hours, 6 hours. It wasn't 4 hours, 15 minutes, something like that. That one was a lot more difficult, and it looked, the IRS was less likely to settle in that case. So I guess in your record keeping, the actual form, the Spiral Bound notebook, whatever's going to work easiest for you will work. But I'd also recommend just as much corroborating information as you can get. The receipts, the name of the contractor that worked on the deck, the painters, what paint was it, what color, when were they there, right? That kind of information goes a long way. So, does that help?
Yeah, thank you.
Sure, yeah.
I arrived a little late, so I apologise if you
It's
told
okay,
me this
yeah.
at the very beginning. This is a hell of a lot of work to become an IRS accepted real estate professional. The only benefit that you've mentioned is writing off passive losses. What other benefits are there to pay for all that work?
Right. No, it really is. The most relevant is going to be if you have passive losses. That's what we're doing. We're speeding up the timing of actually harvesting those losses, because what we're doing is we're taking those passive losses and offsetting the active income. Yeah.
So that's it.
Yeah. But what we're doing, for perspective, hopefully, is taking depreciation losses, right, other things. The properties are going to cash flow, and then we're going to be offsetting active income and speeding up those losses, increasing cash flow, essentially. If you don't have active income, real estate professional may not really be that smart of a move, right? It may not be something you want to do. Everybody should just sit down with their CPA. They should come in for a tax planning appointment, whatever you may want to do, and look whether this is even worth the headache, and also potentially being a target, right? Absolutely. It's not, no one size fits all solutions. Yeah, great perspective. Yeah.
So, what kind of increments are acceptable? Or, just anything but hourly increments?
Mm-hmm. Yeah, so the question is increments, what is acceptable? I'd do the start and stop time. I wouldn't even do increments, right? You may wind up kind of totaling them up just to keep track of everything, right? But say 8:54 to 9:12, checked email, right? Something like that, right? Or checked email probably is more like those investor hours, but 8:54 to 9:12, drove over to the property, condition of law, something like that. Yeah, good question. What other questions? Yeah.
What about doing like bookkeeping? Is that investor, as long as it's on your properties and you're balancing all the receipts, putting everything in QuickBooks, all that kind of stuff?
Mm-hmm. The question is, the bookkeeping and kind of organizing the QuickBooks and everything, entering in the transactions, I'd say that's investor hours. I think the IRS would look to disallow those. So we'd have to argue to get them back included. But really, that's also why I say have way more than 750 hours, right? If you had 1,000 hours and the IRS said, I looked through and we're going to disallow 200 hours, but you're still over the 750, right? So it's a safer position to be in, certainly. I'd rather argue over 50 hours than 750 hours, right?
Well, so I have assisted living homes in addition to rentals. So I'm over there a lot. But so is that still real estate, or is that a business that I'm doing?
Yeah, that's a really good question. So the question is assisted living, because it does have a business component to it, certainly, instead of just the real estate investing. I would argue that it would be included in the definition and count towards the real property trades or businesses. The reason I would argue that is because the tax court, like I was saying, they have taken a really broad definition of what those real property trades and businesses are. I suppose, realistically, the IRS probably would take the exact opposite position, and we'd have to argue about it, right?
But you're providing housing.
Right.
That is the core sense of it.
And there is an investing component to it, right? And so I think that really would be the definition, or I think it would meet the definition. If you look at some of the other examples of these real property trades or businesses, though, I think it's in line. We mentioned construction, for instance. And construction has kind of a more active business component to it as well, but it counts. I think there's even, I'd have to go back and look, but I think there's even something to do with shipbuilding or something to do with docks, and like dock loaders or something. Somehow they pulled that into the definition of real estate as well. So it being such an expensive definition, I think it would favor us if we ever had to argue about it. But yeah, that's a really good question. There is one other component to this that you guys should keep in mind. I mentioned the material participation requirement, so everybody needs to spend more than half their time, 750 hours. You have to materially participate in each activity. That language right there is really important. Materially participate in each activity. What you want to do is make another election on your tax return in addition to the real estate professional election. You want to make an election to group as many activities as possible. So let's say that you have 4 rentals, right? If you don't group, as I'm suggesting, what the IRS will require is that you actually meet the material participation test for each individual rental. Okay, so you have to prove 1, 2, 3, 4 Main Street, I materially participated there. 5, 6, 7, 8 Main Street, I materially participated there. If you make the grouping election, you can group all of your rentals together and count all of that time together to show that you materially participated. So the argument there is, I materially participated in all of my rentals as opposed to each individual rental. Does that make sense? Yeah. And once again, if you make that election, you want to hold on to that like gold. It may be relevant 8 years from now, 10 years from now.
So I'm sorry. Does that mean if you have a group collection of them, you don't have to distinguish the time at each place? You just throw it into the group?
For the material participation test, yes, that's true. And so it's unfortunate that I lost this slide because I would like to show you what all of the 10 tests are that will allow you to meet the material participation. But the easiest one to talk about is that you spend more time at the property than anybody else involved with the property. So let's say that it's you and your wife, right? You spend more time there. You meet the material participation test. If you can show that with respect to all of the properties as a whole, you don't have to prove it for each individual one.
Of course, the log will have each individual one. Right?
That's correct. Yep. Yeah, it's true. But what we want to do for perspective with the material participation is argue 3 or 4 different ways that you meet the test, because that's another area where the IRS will try to disallow things and say, we're not going to allow that argument, we're not going to allow that argument, but this one we're going to allow. Right? And so if there's a time test, and there is a time test around 900, 950 hours, as my memory kind of serves, what we want to do is show that you spent 900 to 950 in all of your rentals versus 900 to 950 in each of your rentals, right? Because you're not Superman, right? I mean, you're not going to be able to put in 950 in every single property, right? So we want to group them, right? And then if we do that, we can make 3 or 4 different arguments for why you satisfy the material participation test. So we're kind of working backwards there. Does that help? Yeah, sure.
So if you have like assistant or you don't want to run around and do all this stuff and you've got someone for you, does that count towards the 750 hours?
So the question is, if you have an assistant who's kind of helping you and you don't want to run around and take care of everything, does the assistant's hours count towards your time? And unfortunately, it doesn't. And it would actually cut against material participation, because one of the arguments that I was using in the example is just that you spend more time than anybody else involved with the property. If your assistant actually puts in more time than you do in the property, it's looking like you didn't materially participate. The IRS will absolutely pick up on that. It's very difficult, and this is an extension off of that, very difficult to prove that you meet the material participation test if you have out-of-state rentals and you use a property manager. The IRS, their first position, it's almost just a knee-jerk reaction, is you didn't materially participate because it's out-of-state, right? So, really good question.
So surprised you hadn't mentioned this yet, but depending on how you file your taxes or run your business, I run and have an LLC, right? All my properties are under the LLC. I take in my income under the LLC, but I just file my taxes like standard taxes. I don't file a separate LLC tax form, right? But if I did, would that help? Or if I filed as an S corp and paid myself separately as a because I'm a broker and property manager and property owner, but I'm paying self-employment tax. I'm like duplicating my self-employment tax as well, right?
No. And so the question there is, he has an LLC. It sounds like it's a single member disregarded entity because everything just flows through to the 1040. There are other elections you could make. You could be an S corporation. You could look at these other things. For real estate professional purposes, I don't think it's going to matter one way or the other whether you're allowing everything to flow through to your personal tax return or make an election so that the LLC is going to file a tax return and that things are going to flow through. Either way, I'd still want it to be a pass-through entity, but that's another discussion. There are other reasons why you would want to move things off of the return and have the LLC make the elections to file a separate return. Legitimate tax planning reasons, self-employment tax being an absolutely huge one. It's absolutely something you should be looking at. But that said, you would want to separate out, and this is kind of a larger discussion, and maybe it's worthwhile having, maybe it applies to more people. If you have rentals and you're an agent or any activity where you're generating self-employment tax, so it may be, there's a business coach here, right? A business coaching would be another example. Construction would be another example. Anything that generates that self-employment tax, having an LLC taxed as an S corporation potentially could make sense. Now, there's a new deduction as of all of the Trump tax changes and everything, the 199A deduction, that may actually impact whether the S corporation makes sense or not. And so we'd really have to sit down and take a look at your situation and see what makes the most sense. But by and large, anything that generates the self-employment tax, LLC taxed as an S corporation, is going to be at least worth considering. Then your rental properties should not be grouped with your S corporation or your self-employment tax activity for a couple different reasons. Number one, rental is per se passive, right? And so it doesn't generate self-employment tax. We don't need that level of planning. You don't have to partner with a payroll company. You don't have to pay a salary. You can just take the distributions, and there's no self-employment tax on that. So we can keep it more simple. Another reason we might separate it out is for asset protection reasons. If a tenant slips and falls, we want to kind of compartmentalize the risk, compartmentalize the harm just into the rental structure. We don't want it to come over and get your self-employment tax generating activity, or vice versa, right? So there's an asset protection concern, also tax planning concern. The other thing is with an S corporation, if you put the rentals in, the exit strategy is a lot messier with rentals. And if you ever were to transfer title for any reason, let's say you needed to refinance the property or something like that, the tax code actually would treat that as a sale. And so you actually trigger a taxable event, even though you don't have any cash because you didn't actually sell the property, right? And so you could generate a very large tax bill for yourself. So we just want to separate things out, have the best tax strategy for what really generates the income. But absolutely, moving it off the personal tax return, getting the activity off the 1040 actually reduces your audit risk as well. So it can be really useful. So I think independent of real estate professional status, there's a lot of really compelling reasons to do it and look at it. It's really the bulk of what I do is setting up LLCs and structuring and doing all of that. So anybody who wants to talk more about that, I'm happy to talk after this, or I do complimentary consults as well. We can meet in my office or have a phone call. So, yeah, great question. Yeah. Yes.
Brief aside is Roth IRA, self-directed, narrow expertise through that.
Yeah. So an aside, Roth IRAs, any IRAs, even 401s. Yeah, absolutely. I do quite a bit of work with them. Something that I do, and maybe this is what you're looking for, is a single member IRA LLC, where you are actually the manager, you have checkbook control, IRA's the member, all of the profits and everything still stick with the IRA, but you as the manager, you can identify what properties you want to pick up, purchase, all that. Absolutely. It's funny where life takes you. I never asked for that type of work or really even knew much about it, but so many of my clients were clamoring for it that I did develop an understanding of that, and now it seems like I might be one of the only people in town who do it. so it's just funny where life takes you.
You touched briefly on this. Would you be able to go into any more detail on the qualified business income, the 20% deduction that just came out in the new tax rules, and how that might apply to to, let's say, holding rentals in an LLC, not in an S corp, but just an LLC, is there any way you can offset the income just by 20% through that?
Yeah, I will from a really high level, because actually that 199A deduction gets very complicated very quickly.
Yeah.
If you fall into existing categories, it's really straightforward. When you get into some of the boundaries, it gets
Let's
complicated.
just go in the existing categories.
Basically, yeah. I mean, qualified business income is this new category of income that they defined in the code, and rental income appears to qualify. There's still a lot of guidance that we need about this, and a lot of, for lack of a better term, I guess, hand-holding. But what's interesting is in the congressional history and the legislative history of them passing this, real estate investors were actually included kind of at the 11th hour when they were drafting this. And so indications are that this qualified business income should actually include rental real estate. We just don't have the solid guidance, or at least that I'm aware, that says yes, rental real estate is qualified business income. But to be fair, we also don't have a whole lot of guidance about what actually qualified business income is outside of even the rental context. So we're still waiting for a lot of clarification. That's my first thing. But rental real estate should qualify. So you have this qualified business income. You have other deductions that you might take, okay? And so there's certain, it will reduce the potential qualified business income that qualifies for this 20% deduction. But when you get to how much qualified business income you have, yes, there's a 20% deduction that you can just deduct off the top of that. And so additional money right back into
Any
your
properties owned by the LLC, after your other deductions, you should be able to appreciate qualified, or reduce your qualified business income by 20%.
Correct.
As long as you're not under the other exclusions, that you can cover this stuff.
Yeah, there are phase-outs if you have a certain amount of income. Also, there are phase-outs. Well, I call them phase-outs. It's technically not a phase-out, but there's different rules that apply if you fall into kind of a specified type of taxpayer, like an engineer.
But wouldn't that only qualify for income? Because I've been reading this, but let's say you're a physician. Would it only be income that you earn as a physician, as a business as a physician? Would that be separate from your LLC rental income? Or do they lump all the income together somehow?
Potentially. I'd actually have to look at that. Yeah, that's a really good question. My sense is that it would be separate. I think if the source of the qualified business income is related to being a physician, one of these kind of specified people, then yeah, there's different rules that apply. We'd have to look at it. Yeah.
And just to understand, when you say that you guys are still waiting for clarification, is it a case of all the tax professionals are going to interpret it how they may, file the returns accordingly, and then just wait to see how the IRS treats them, or are we going to get clarification before next time?
Source of law is a really interesting topic, because you have the tax code, you have the Code of Federal Law, what the courts have said, and then you also have IRS guidance, right, and Treasury guidance as well. So we are waiting, because there hasn't been a whole lot of Treasury guidance by this point. There hasn't been a whole lot of IRS guidance by this point. There are no cases interpreting this new law. And so really we have a few regulations, and we have the code itself. And so we're just kind of waiting to see. And the only way we're going to get case law is pretty much what you're describing. Return preparers will prepare the return, we'll take positions, IRS will challenge them, it'll go to court, we'll get precedent, and we'll go from there.
They're giving no guidance other than
We'll have more guidance. IRS eventually will publish guidance, right? The Treasury Department of Treasury will publish guidance, but I think everybody right now is still picking through and still trying to think, how does this work? What does this look like? We're still only 6 months in, right? If you think about the last time the tax code was majorly overhauled, it was 1986, right? So we're not going to have all the answers in 6 months. We're just not. Great question. Yeah. Not a satisfying answer, but a great question. Well, we've had a ton of questions. Any other questions? What else can anything not related to real estate professional? Okay. Well, I hope everybody found it helpful.
Yes, Peter.
Very
Thank
much.
you.
Yes,
Thank you.
Yeah, great.
That doesn't happen to include a lot